Artificial intelligence, electric vehicles, renewable energy. The news cycle locks on to a new technology every few months. Suddenly, you are surrounded by stories of people making massive fortunes. The charts point straight up, the headlines flash green, and that familiar pressure sets in, the fear that if you don't buy right now, you will miss the opportunity entirely. So how do you participate in a massive economic shift without putting your money at risk right at the peak of a bubble? We have to start by separating the technology from the business. Look at this vintage electric car. It proved the concept worked, but engineering success does not guarantee immediate market dominance. We saw the exact same thing play out in the late 1990s. The internet was absolutely going to rewrite the global economy, yet thousands of early internet companies burned through their cash and went bankrupt in offices that looked just like this. This trend spectrum matrix maps these situations. The vertical axis measures price, from cheap to bubble. The horizontal axis measures actual utility. The trap is the top right corner, high utility, but the stock price is in a speculative bubble. Buying into an inevitable technological shift at the wrong price can destroy your portfolio just as quickly as buying into a complete scam. To protect your capital, we can use this three-gate analytical flowchart. It starts at the top with Gate 1, business validation. The first test is simple. Does this trend solve a real-world problem? Does it save people time or noticeably reduce costs? When early e-commerce arrived, many doubted people would buy things on a computer, but it allowed shoppers to instantly compare prices and access a wider variety of goods without leaving home. It solved a concrete problem. If a company passes that test, we look for a mathematical path to profitability. We need to see rising sales and a debt load that the business can actually manage with its cash flow. Applying these two strict rules acts as an instant filter. It strips away the marketing hype and leaves you only with companies building durable changes in the market. There is a clear trade-off to this approach. By demanding fundamental stability, you will completely miss out on the short-term, explosive gains of meme stocks driven by social media hype. But a compelling story and a charismatic CEO cannot pay the bills. If a business model cannot survive its own debt load, the stock will eventually collapse. Once a business is validated, we move down the flowchart to Gate 2, value chain and price. Instead of focusing on the famous consumer brand, we map out the underlying infrastructure. We look at interconnected suppliers providing chips, servers, raw materials, and maintenance. During the expansion of the railroads, thousands of operators went bust trying to run the trains. The reliable profits went to the unglamorous businesses, supplying the rails, the timber, and the tools required to build the tracks. Once you find a reliable supplier, you have to measure its price using an earnings multiple. This tells you exactly how much future growth the market has already priced into the stock today. When a trend is dominating the news, investors bid up the pioneer companies so high that the price reflects a perfect, error-free future. If the company hits even a minor speed bump, the stock plummets. By looking further down the supply chain, you can often find financially stable businesses trading at much more reasonable prices relative to their risk. The downside? Investing in B2B server manufacturers won't impress anyone at a dinner party, and it requires hours of reading dry financial reports to understand their business models. But the company making the most noise online is rarely the company capturing the most secure profit margins in the real world. The final phase of the framework is Gate 3, risk execution. This is where we set the mechanical rules for actually putting your money to work. The first rule is to use phased fractional buying. Instead of going all in on a single Tuesday, you spread your purchases out over a timeline. By looking at this graph, we see how averaging your entry points physically protects you from deploying all your capital exactly when a hype cycle hits its peak. The second rule is strictly capping the total size of your investment. You decide on a maximum percentage of your portfolio in advance, ensuring that a total loss won't touch your emergency fund or retirement accounts. The third rule happens before you spend a single dollar. You write down the specific conditions that would force you to sell, like a change in management or a sudden spike in debt. Defining these exit criteria in writing changes how you respond to market volatility. When a stock's price drops or the fundamentals shift, you aren't making a snap decision under pressure. You're simply following the instructions you gave yourself when you were thinking clearly. Phased buying does limit the absolute maximum returns your portfolio can achieve. You are sacrificing peak lottery ticket wealth to ensure your long-term survival in the market. Spending weeks researching when to buy is entirely wasted effort if you lack a disciplined, emotionless plan for when to sell. Who should commit to this rigorous evaluation framework? This matrix matches your reality to the right strategy. If you have the time and discipline to read balance sheets, map supply chains, and ignore media hype, this system gives the active analyst maximized risk control. But let's be honest, most people simply don't have the time or informational edge required to consistently beat Wall Street at picking individual winners. For the passive investor, the solution is utilizing broad, industry-specific ETFs. This gives you exposure to the macro trend while completely eliminating the risk of a single company going bankrupt. As a passive investor, you must accept average market returns. In exchange, you reclaim hundreds of hours and remove the threat of catastrophic loss. Finally, there is the speculator. If you ignore the analytical framework and refuse to use broad ETFs, you are building a portfolio based entirely on hype, and when the hype fades, it collapses. Understanding the underlying technology of a new trend is only 10% of the work. Managing the valuation price and managing your own ego is the other 90%. You don't need to be the first person to arrive at a trend to make money, but you absolutely need a system that protects your hard-earned capital from your own emotions.